Welcome to Barchart's weekly series of webinars designed to help you, the investor or trader, to better understand a variety of trading concepts, as well as the pages and tools that Barchart provides to help you make a more informed investment decision. Today's subject, unusual options activity. Barchart's unusual activity page design is a simple idea. Screen for large volumes in specific strike options, compared that to particular contracts' open interests, and that this type of options activity can provide us an insight into the smart money, institutional players, and the big bets that potentially could create big price moves that they represent. Hello, my name is John Rowland, and this is a very simple idea. This page is simple, but on deeper introspection, we will reveal that there is a variety of complex concepts underneath. So stay with me today as we discern between what is truly unusual and what is maybe just unique, but normal for the business for these large institutional traders. As always with me is someone who is certainly is unique, but not unusual, is my partner, and Peter Gene Baker. Hello, Gene.
Hey, hi, John. Thanks for that introduction.
You like that, huh? Okay. Well, happy Thanksgiving.
Thanksgiving. No, wait. John, are you already out at the bar tipping a green beer back today?
I think so. Yeah, exactly. No, I meant happy St. Patrick's Day.
Yes.
So hope that you have a whiskey or maybe some corned beef today, right?
Right.
Is that on the menu or not?
Absolutely not.
Okay. Well, Gene, you've told me in the past that this is one of our more popular pages, so I'm kind of looking forward to digging deep into it, and I'm sure you are as well.
Yes, it is. A lot of people come to Barchart to look at this unusual options activity page, so we're going to learn all about it today with you.
Well, maybe not all about it, but certainly a lot about it. Okay. So just to remind you that today's session is for educational purposes only, and that any form of trading has some risk, and so that it's important for us to understand risk, and as individual investors or traders, to make sure that we can afford that risk, and in light of our financial condition. And it's important that we also recommend that before you make any decision inside of investing, that you consult with a qualified financial professional. Okay, cool. All right. So what I want to do today for you guys is I want to weave together a couple stories. And the first is, how to read our unusual options activity page and what things we want to look for to separate from what is truly unusual and what is just maybe part of the business of institutional money management. And the second story I want to weave in here is that what strategies, or maybe better yet, what food for thought for you guys is to take advantage of this information that we're going to find on our unusual options activity page. All right, so here we are on our page, and what's nice about this is it kind of lays everything out for us, right? And again, it's very basic and simple in terms of the information that we get here. We have our symbol, the last price that stock or security trade, what type of option was part of this unusual option, the strike price, the expiration date of our option and our days to expiration. Then we can look at what is our bid midpoint and ask. And this is kind of going to be cool because we'll be able to see if prices are rising or falling, which could give us a clue if somebody is buying or selling a particular option. Now, there is another tool that we have here that I'm going to show you in a little bit that could give you a clue in this idea of looking for buyers and sellers. And then our volume, our open interest, and our volume open interest ratio. And so how our unusual options page is designed, it will lay out based on this volume open interest ratio. Okay, so the greater the ratio is really how much more volume than we do see in open interest, and that's how this is laid out. Now, like any one of the lists or pages that we have, you can sort these by the individual input. I could click on volume and it would go and sort this by volume, or I could click on open interest and it could go from greatest to smallest, or I could do it by my ratio again. So if I did volume, it'll show me the ones that have the largest volume. All right, or I can go back to my ratio. All right, so this is where we're going to start our investigation process. This is where we're going to start doing our due diligence. What we're going to do is we're going to compare our volume, right, of this particular option. And what we want to do is we want to compare it to other calls or puts, depending on what we're looking at, of similar strikes of the same time to expiration. And also, we want to look at our daily volume averages of options throughout all options for this particular security. Okay, so one of the ones that popped to the top of our list today was CCJ. So I'm going to go to CCJ first, and this is where I'm going to start my investigation. And so if I scroll down just a little bit here, here's my options overview. And over here on the right-hand side is where I'm going to start doing that comparison, right? I'm going to look at today's volume, right? So you can see today's volume, total volume of all the options is about 54,000. Our 30-day average is 33,000. So what we're seeing here is we're seeing an increase in volume over our 30-day average. That's could be very significant. Also, I want to look at my daily volume as the volume of my option, my unusual option. So we can see that for CCJ, this one option is 22,000 volume. In other words, it's representing almost half, or about, maybe a little bit less, 40% of the daily volume in options. So that's a lot more significant. And that's what kind of things we want to look for. We want to make sure that this unusual volume option is unusual. In other words, large in comparison to what we would see normally on a day-to-day basis. The other thing that I will look at also is, my open interests and my volume, right? And so, for instance, this 22,000 contracts in this particular option represents, maybe only 5% of the open interest. Maybe not very significant in terms of a percentage, but that's the kind of things we'll look. We might find an options volume that will represent 50 or 60 or maybe 100% of the previous open interests, and that would be a lot more unusual. All right. Okay. So now, again, going back to our unusual option, we see that this is the April $16 expiration, and it's the $22 call. So I'm going to go back to here under the CCJ page, and I'm going to click on option prices. And now I'm going to start doing that more deeper investigation. And so I'm going to make sure that I look at the right strike expiration, my April 16s, and I'm going to scroll down to the bottom of the page here, and you can see that today's volume, 41,000 call volume, represents about half of the total open interest. That is quite significant. Again, if I see much higher ratio, let's say 100% or greater, then that would even be more significant. So that could be unusual. Now, if I go to the actual calls that are on trading here at the April 16 calls, I do see that $24 call has 27,000. I also do see that the $25 call has 19,000. The 22 call has 22,000, right? And our previous open interest was only 749. So you can see that compared to all the other strike prices, this is a large amount of volume compared to other strikes for today. Now, there is some other open interest that has been created in this particular market, and we'll come back and look at this in a second, a little bit later. But certainly this huge volume in an option that had very little open interest could be a little bit more significant, okay? So we look at the big picture, the overall, and then we're going to deep down drive into it. Now, what I also could do is, at this point, somebody might say, well, you know, am I seeing somebody buying this, or am I seeing somebody selling this? Yeah, they're opening this position, but are they actually buying it or selling? So one of the things we can do is we can go into the price history of this particular option. And what we'll do is we'll look at what price action has been happening throughout the day. Now, you got to kind of imagine what is going on here. As you can see, here is the date, our date, March 17th. And our opening price was 53 cents. Our range of price is 75 cents to 45 cents. And our last price is 71 cents. So what has price done since the opening? Well, it maybe went down a little bit, but it's only gone higher. And so when somebody is buying an option or initiating a long position, they're going to probably have to buy the offer, right? And bid the price up, in other words, or take the offers as it goes higher. So when we go back to our unusual options page, a lot of times what you'll see is there'll be a color here. And it was just recently green, just means the last price was traded at the same value. But if somebody is buying this option, then it would be green. And that would give you an indication that someone is buying at the ask price. Vice versa, if we see red signals, that could be telling that somebody is hitting the bid, or in other words, selling that option. Now, somebody might sell to get in, but it's just telling you what is going on in that particular options, okay? All right, so those are two ways you can look at to see if somebody is opening a position or closing a position, all right? Okay, so let's go back to our unusual options page. And so that's going to set us now on our next step, right? We've looked at volume and we started to look and see, is this unusual compared to the other strikes that are around, or the other puts or calls in that expiration. But what I want to do now is I want to think about, is this option trading, is it a part of something called an option spread? Now, there's a variety of option spreads that are commonly used. Vertical spreads, sometimes you might hear them as debit or credit spreads, bull calls or bear puts, straddles and strangles. And what we're going to do is we're going to compare the nearby puts or calls to see if we see some information based on that unusual activity. All right, so let me show you an example here. Okay, so here is a screenshot from March 9th. Now, this is on our unusual volumes page. This is also a new feature that we have in our on the website. And what this one is very similar to our unusual options, but it looks at all the volume of a particular security. And you can see that Western Union was right at the top of the list, and it's showing that the call volume was 44,000, right? That's a lot of volume. So again, I'm going to have to do that process and I'm going to go back to Western Union. So 44,000 volume was in Western Union. And we can see on the Western Union page that our average daily volume for Western Union options is only 4,000 contracts or 4,600 contracts. It's 10 times the normal volume that we would normally see. So that would be something that would be unusual, right? But again, we want to make sure that it's not part of a spread. So here's Western Union, and we're at the right strike, right options expiration. And here is that volume. As you can see, 10,000 traded on this strike, 11 here, 10,000 here, and 11 here. So there's our 44,000 volume. But what we do see here is that some of the volume is related to already previous open interest, and some of the volume is this unusual activity. What we're seeing here is whoever is doing this trade is probably doing some form of a vertical spread. In other words, they had the $28 vertical spread on. They had 10,000 of them. They're selling those out, taking those profits, and establishing a new vertical spread, the 26.30 spread. So is this unusual? Maybe more unique, or is this just part of the process of somebody who is already long Western Union or long Western Union options, who is just taking profit on one call spread and putting that money to work on another call spread because they believe the price of Western Union is now going to go higher? So is that part of a potential roll or a spread? So let me give you one more example before we move away from this. This is a Citi group, right? And it popped up on top of the unusual options page. This would be the unusual option page. And here's Citi. And it's showing that the $80 put, right, had 2,000 contracts traded, and previous open interest was only 100 contracts. So that would be, a large increase in open interest if this was somebody who's adding to a position, and it probably is, right? But again, what we said was we want to start looking at, is this part of a spread? And what we would do is not only do we look at the options that are around the $80 put spreads, puts, but also notice now here we do see under the calls here that the $80 call had 2,000 volume. Now the open interest was already 4,000. So on further investigation, what we would discover on this one is somebody had already purchased $80 calls. The stock price had started to go up. They took profits on those calls, and now they're buying $80 puts, right? So which takes us to the next part of our investigation. What are the details of the trade, right? What is going on in this trade? Is my strike in the money? Is it at the money? Is it out of the money? When is my expiration, right? How long a time between now and the time of expiration? What are the ramifications of somebody exercising these options? And a very important component would be, will the earnings for this particular security, earnings announcements fall into the expiration time? Now, this is going to be more critical when we look at shorter term or shorter dated options. If I can find a shorter dated option that is going to fall in terms of my earnings date, then that will be more significant. That could be unusual. And also, we're going to look at, is there a relevance to the strike, to my break even? And we're going to do a little chart analysis at this point too, to kind of give us an idea, to try to get in the mind of our trader. So first of all, let's look at this, stay with this trade. Here is our expiration, April 16th, and here's our earnings date, April 15th. And yeah, that's significant, right? So somebody is buying these puts, right, just before they're going to expire the day after the earnings. Now, what's the ramifications of the trade, or what's the details of the trade? Well, somebody is buying $80 puts on a stock that's only trading $73, right? So they're buying in the money puts. Now they're paying, it looks like, somewhere between $7.50 and $8 for that privilege or that right to be short Citi at $80. So that means that their break even puts their price at around $72. So could this be significant? Yes, it could be significant. So we would go to our chart, and here's Citi. And again, let's look at this trade. So somebody is buying an $80 put with a $72 break even. If we look at this price action, kind of makes little sense to me, because it looks like if I was long Citi and I wanted to protect myself to the downside, yeah, I would buy puts. Now maybe, I'd probably maybe buy puts that were out of the money or at the money, maybe not in the money. But think about this. Maybe somebody wants to take control of Citi, short Citi, without having to borrow the stock. And this is the way they can do that, by buying an in-the-money put. Now, $80, is that significant? I don't know. But if I went to a higher time frame, what I would notice is that, yeah, $80 is very significant for this particular stock, because it represents the high of Citi over the last 3 years. In fact, going back to the beginning of January, before we went into lockdown and the COVID. So somebody here is now using that $80 target zone. So there's a lot of significance to this. But now we're going to do one more part, right? Which is going to take us to the next thing that we're going to do, is we're going to look at the value of the trade. In other words, the bet, right? What does this trade represent in terms of dollar value? And what does it represent in terms of shares that are being controlled? So we look back at that trade, and it was 2,000 contracts. 2,000 contracts, every one option contract is worth 100 shares. 2,000 times 100, 200,000 shares. So this trade controls 200,000 shares. Is that a lot? Maybe, maybe not. Again, we'd have to do our comparison. So if I look at Citi in general, right, on my options, right, it trades about 80,000 average a day. So 2,000 is not really a lot. And if I think about 200,000 shares on a stock that trades 21 million shares, maybe not as unusual. This is just somebody doing part of their regular business. Might not be something that I want to take a trade on based on that information, okay? And I think dollar-wise in this one, I think it came out to about $1 million. Now, I know for you and me that $1 million might be a lot of money, but somebody who is managing, billions of dollars, that's a pretty small bet. Okay, so finally, what we're going to do now is we're going to look at, is this options activity distorting our implied volatility, right? And we're going to compare this implied volatility to our historical implied volatility, our ranks and percentages as well. So I will refer to you guys to a webinar we did a few weeks ago on options, ranks, and percentages, and talked about the different strategies that we can do based on rank and percentages. But let's go and look at Citi in this case. And right, our implied volatility is 36, our historical is 35. Now, our rank and percentage are low, so that would tell us that options in general here are relatively cheap. So buying options would definitely be the way to go. So this person is buying puts, but they could be relatively cheap in terms of our volatility, right? And if I again went back to my document, right, at the time of the trade, my implied volatility was right inside of that historical and current range. So it's not outside of the realm. It hasn't really distorted the implied or historical. Now, I do want to remind you that on the options overview page, that implied volatility is based on the nearest monthly contract, and that the historical is a 20-day historical. Okay. All right. So in this case, it didn't really distort our volatility. All right. And that's really what we would anticipate. All right. So we have all these things we want to look at, and now let's see if we can put it all together, right? In terms of choosing a strategy, or at least in determining which one might be a better fit, okay? I do see a lot of questions coming up here. I do want to try to get through a lot of material, and I would promise you I will get to a lot of your questions here. But let's be frank here, all right? And I want to be very candid, all right? There is no right or wrong option strategy, all right? It all depends on you, the individual trader, right? Your goals and your risk tolerance. If I present a variety or all the variables of an unusual options trade to 100 different options traders, I guarantee you we would get 1,000 different strategies, all right? So one of the things that the way I kind of look at it is this, and I use, maybe you've heard this expression. Have you ever heard, you got to dance with the date you brought? Yeah, so what I'm going to do is when I look at my unusual activity, I'm going to make sure that our strategy, or the strategy that I'm going to employ, is going to be based upon the expiration of my unusual options activity. You know, if that activity is, let's say, in a long dated, an expiration that's, 90 days out, I'm not going to look at a weekly option, right? Because it's not going to be relevant to it. And vice versa. If I see options activity in a weekly, let's say, 10 or 17 days out, I'm not going to look at a 90-day option, right? Because they're cheaper, or because I think that that's what's going to happen. I'm going to play what is going on, what is the institutional. I'm going to ride their coattails, so to speak, right? So I'm going to dance with the date. In other words, the expiration date. So let's say I believe a stock is going to go up and it's going to appreciate in price over a certain period of time. And I've done this investigation based on my unusual options page, right? And I don't know how far or how fast that stock is going to go. I just know that there's unusual options in a longer dated option. So what I want to do is I want to find options with higher deltas, because the higher the delta, the more bang I'm going to get for every dollar movement of that particular stock, or benefit from the coming price appreciation. And typically at the money options have deltas around 50%, but I want to find deltas that are somewhat greater than that. And I want to start looking maybe at 75%, right? Which means that now I'm going to be dabbling in the money options. Now, I know what you guys are saying. Some of you are options traders are saying right now. You're saying, John, those options cost a lot of money. Yeah, they do dollar-wise. But think about what they represent and the result, remember, the results of the trade. If I buy a $40 call on a $50 stock, where I see unusual options activity, long dated, of, let's say, at $55 or $60, right? Maybe that option will cost me $12, $10 of intrinsic in the money value, and $2 of extrinsic, that premium, right? And so for one option, it cost me $1,200 to take control of 100 shares of a $50 stock. Now, if I just bought, I believe that stock was going to go up based on this unusual options activity, and I just wanted to buy the stock, and I bought 100 shares of a $50 stock, that would cost me $5,000. So the option allows me to take control of a stock for 20% less, or 20% of the price of the total shares. Now, if the price of the share goes up, let's say by 10%, $50 to $55, well, my 75% delta option is going to appreciate by $3.75. That's a return of 31%. The stock owner only gained an appreciation of 10%. And I'm getting leverage because I'm using options of 31%, which is kind of cool. That's why we trade options, because of that leverage value. Now, some of you might say to me, well, maybe when I do these in the monies, there's a lot of intrinsic costs, right? A lot of intrinsic costs. And so what I would do here is, now I'm going to apply some of those other strategies. In this case, a vertical spread, where I might buy that $40 call. It cost me $12. But because the implied volatility, because my large institutional traders buying the $55 or the $60 call, they've blown that price out a little bit. They've added more value to it. So I'll sell them that $55 call and put on a call spread. Now that $12 investment, right? And let's say they blow out the $55 call to, let's say, $3.50. Now my cost is only $8.50, right? $12 minus the $3.50 that I'm going to take in. It's going to lower my cost, but it also caps my potential profit, right? But $8.50 on that trade on a $15 spread, $40 versus $55, my profit now, the difference between my cost and the difference of the spread, would be $6.50. That would be, if the stock price got up above $55, that would be a 76% return on my money. Again, my stock, if I own the stock, I only made 10%, but using a vertical call spread that helps finance being long this in the money call, I've now made 76%. Okay, so that's the basic idea, all right? So the one that I saw that popped up this morning, let's see if I can find it, is here, DraftKings, okay? So DraftKings is trading $67.60. It's an $85 call, right? And it's 156 days out. So now the expiration is not going to be an issue with our earnings. There might even be one or two earnings in there, so that's not going to be a question for me. So, but I do see that somebody has bought or traded 11,000, almost 12,000 of these options, and the options beforehand was only 950. Okay, so I've got go to DraftKings again. I want to look at volume, that whole big picture, right? And today's volume so far today is about 68,000. Our average is 170. The state's still young. We still could get more out of it. My total open interest is about 600,000, 640,000. Yeah, it was a very small percentage, right? Okay, so there's not a lot of unique unusualness in this. This could be just part of regular business. But let's go to the options prices. And we said that it was the August, I believe. And yeah, there it is, the $85 call, 11,000 contracts. Now, remember what we said. The next thing we want to do is see, is this part of a spread? Now, right today, doesn't look like it's part of a spread, but we do see that in previous price action, previous days, somebody has accumulated $10,090 calls, all right? So again, we could go into our price history here and just do a little due diligence and look to see, hey, what's going on in our $90 calls. And you can see that back on March 10th, we had 16,000 volume and there was no open interest. So this would have hit our unusual call or usual options activity. And the next day, what did the open interest do? It went up by 15,000. So that telling us that they're opening that position. And then about 4 or 5 days later, you see that we did have 11,000 volume in the $90 call on that $15,000 open interest. And the next day, what did open interest do? Well, it went down by 6,000. So that's just telling us that this price action that we saw on the 15th, that person was probably taking profit. Now, let's say how they did. They started buying this option around $4.75 and went paid as high as $7, and they sold them between $6.15 and $8. So it looks like they made money. So what is happening now is looks like they're taking that profit and now putting it back into the market, right? They're going back into the $85 call. So this might not be a direct spread, but it's probably just somebody who is just continuing to play this market, right? The $85 call. So what did we say? We have a long dated option, and we want to find those that have greater deltas, right? So I'm going to go to my volatility in Greeks, right? And I said somewhere around 75. So here we have a 75 delta on a $55 call. It's going to cost me $18.70. Yeah, that is a lot of money. I agree. Yeah. But the stock right now is trading $67, close to $68. So $13 of this price is intrinsic, right? That's in the money. And so only about $5.50 to $6 is that extrinsic or that premium value. So if that is too expensive for me, right, then what can I do? Well, let's say that this trader now is telling us they believe that the price of DraftKings by August is going to be above $90, right? The $85 call they're paying $6 for. Their break even is $80, $91, $92, right? So that's their target. So what can I do? Well, I could sell them this bloated, right? Or this, if it was distorting open implied volatility, I could sell them this call and thereby offset the extrinsic portion of my $55 call. And think about it. Now I only have cost is $11, right? Just the intrinsic portion of my option, and I'm taking control of a $68 stock for $1,100, right? That is a pretty cool thing for me to do. All right. Okay. So that's a long dated, right? So on a short dated, what we're going to do, let's say we're looking at an unusual options activity, and it's inside of 30 days, right? Inside of that, when theta starts to pick up, a lot more decay, right? Well, I want to look at options with higher gammas. Now, in our previous option sessions, I've always introduced you guys to a new Greek, right? We talked about theta and decay, and as time goes on, we talked about deltas, change in stock price, change in our option price. When we did the percentage and rank video a few weeks ago, we talked about vega, this volatility of volatility. Well, gamma is the delta of delta. In other words, it's showing us how much our delta is going to change with the change in price. Delta doesn't stay the same. It will go up and down, right? Especially as price moves away. So typically at the money, options have higher gammas, and shorter dated options have higher gammas as well. So we want to find those that have higher gammas because we want the delta to increase. Remember that higher delta, then my option acts more like a stock. So we want to look for those higher gammas, all right? So if I look at gammas in terms of puts and calls, again, I probably wanted my delta to be at least 50 or greater. If I'm looking at calls, maybe I'll go try to get higher, maybe to a delta of maybe 60, 65. Puts, I can stay right at 50. And that's because we've talked about this in the past when we did trend analysis, that bull markets tend to take the stairs. They go a little bit slower, and bear markets take the elevator, right? They tend to fall a lot faster. So we probably want a little bit higher delta for our calls than we do for our puts. But if I go to CCJ, let's go back to CCJ because this was a 30-day delta. And let's go back to our Greeks. Or excuse me, 30-day expiration, not 30-day delta. What did we say that one was? The April 16th? Yeah. Okay. Let's check on this one again. Something seems a little unusual here. Let me just make sure I got it right. So $22 calls on the 16s. 16, 22, so I'm a little bit out of the money. So let's show all. And there's our volume, right? There's that crazy volume, 33,000, right? Very significant, right? So let's look and see which ones of my strikes has the largest gamma. And it looks like around, the $19 call has the largest gamma. And it's going to cost me about $1.50. So my break even, $19 plus $1.50, my break even is $20.50. My unusual option is at $22. So that works for me, right? Because I'm going to anticipate that my large institutional traders telling me that they believe in the next 30 days that this stock is going to get above $22. What are they paying? They're paying $22. They're paying 60 cents. They think it's going to get probably closer to $23. But if that is too much for me, my stock right now is trading right around, I think it looks like $19, $18. If that is too much for me, what can I do? Well, I could sell that $22 call if I believe that it's being bloated, and my $1.50 cost on my $19 call was now down to 90 cents. I'm doing a $3 spread, cost me 90 cents. My potential profit is $2.90. Now I'm getting closer to, 200% return or 225% return on my money, 90 cents to make $2.25. That would be something that I would be interested in doing over the next 30 days. Okay. All right. So I do want to show you one more example, and then I will address a lot of the questions. I see a lot of great questions popping up here. Okay. So let's go back to unusual options. And one of the cool features that we have here is it says latest date. That's today's date, right? But I can go back and I can go back in time if I want to go back and see what has happened to an option or to a particular stock and see if there's maybe like a regular rotation, a monthly rotation or something to that effect. I can go back and look at time. So I'm going to go back in time. Wake up, computer. Wake up. I'm going to go back to February 24th. All right. And I'm going to now really drill down here. I'm going to show you a particular stock, one of the ones that has been in the headlines, GameStop, and I'm not going to look at puts. I'm just going to look at calls. And what we see here is, it should jump right out at you guys, right? Here is the $60 call that has 2 days to expiration, right? And somebody is paying $30 to $35 for a $65 call or $60 call, right? Look at that, 16,000 volume. Look at the $50 call, right? 18,000. They were paying $40, right? Now, if I went to the history of this contract, right? Go back and look at the history of this trade. On that date, the 24th. I wanted to show you how unusual this was. The day we opened up, this option was trading 60 cents. And by the end of the day, it was trading $35. So somebody knew something, right? Earnings is not having an effect on this market. It's not going to make this stock move $35. Somebody knew something, right? And the next day, yeah, sure enough, the CEO of GameStop announced that he was going to step down, and the stock price went shooting up. But I also want to show you something that was really amazing is not only were they trading in the 50s and 60s and $70 calls, somebody bought 3,000, 4,000, 3,000. Yeah, see how our volume went up, our open interest up 2,500, $800 calls, right? And if I go back to GameStop, let's go to the chart. There's our 24th. Here's GameStop, 24th. Look what happened. The stock has started out in the morning at around $45, and that options activity, that unusual options activity, actually drove the stock price up. Talk about the tail wagging the dog, right? And the next day, the options, right, appreciated, right? Look at the stock opened up at around $1.65. So those $60 calls that they paid $35 for, which would have a break-even price of $95, are now made, close to $100. So a $3,500 option is now worth $11,000, right? 3-to-1. That is very unusual and very dramatic. Now, this is not atypical of unusual options. I just wanted to show you this example of what things that you can kind of look for, right? And, this kind of event, this is, in a trader's lifetime, this might be a once in a lifetime event that you would see something like this. But when you see something that dramatic like that, when an option and volume and price and volatility all are distorted, and that is definitely a sign that something unusual is about to happen. Okay. All right. So let me get to some of your questions here, and then I'm going to give you guys a couple of takeaways here. So we're right on time, right, Jean?
Yes, that's right, John.
Okay. All right, so Aaron asks, he said, first of all, thanks, Aaron, for wishing me a happy St. Patrick's Day. He asks, what's more important in unusual options? Is it the open interest or the volume? I think, Aaron, you got to look at both, right? Right? If I'm looking at an unusual option that already has open interest, right, then maybe that is not unusual unless that volume is a huge multiple of it, right? Again, we want to use that comparison of volume, open interest, and the bigger picture, the volume, daily volume of my market or my stock or my security, and the established open interest, right? So we want to see how they compare, right? All right. Danielle asked, what's the different color and strikes between green and red? I think I answered that, Danielle. Joseph says, how much time is it between when the option is considered unusual and when the contracts are on purchase? So I'm not sure what you're asking here, but I think what you're saying is there's a time delay. I think, Jean, our unusual options page is what, a 15-minute time delay? Is that correct?
Right. They're delayed 15 minutes, and a lot of our options strategies, like the screeners, we redo these strategies every 10 minutes or so during the day.
Okay, cool. All right, let's see what we got. So we got a question is, if the price of the option is going up, does this mean the price of the stock or the security is expected to reach that strike price? Not necessarily, right? It just means that somebody might be buying insurance, right? Somebody could be buying puts that on a stock that they think is going to go up in price. They're just buying that put to protect them to the downside. So that's not necessarily the case. But if we're going to play an unusual options trade, especially then if we see an unusual options trade that is outside of current price, out of the money, that could be significant, and that could tell us if prices are going to go up. All right. So Vive asked about direction of price and volume, and I think I answered that. Look at your price histories, look at your opening price of your option, your highs and lows, and if you see prices increasing through the day, then you know that they're buying them. If you see prices decreasing, you know that they're selling that particular strike, okay? So John Smith asks, is it more important on selling options? What is more important, volume or open interest? Again, John, I think it's, again, that whole, basket of information, right? I don't think I'm going to put one importance over another. Now, if I'm talking about selling an option and I'm talking about collecting credit, I think what might be more important to me is looking at my implied volatility and see if that option is bloated, right? In other words, that there's a lot of intrinsic value in it. And also, I probably want to find ones that are shorter dated that have higher thetas, greater decay, okay? Mohammed has asked me, how much importance do you give to the put-call ratio? Well, sometimes not. Depends, right? I mean, you will see that skew, right? That skew sometimes, right? And again, if you're seeing a lot of call option and your stock is in a long or extended uptrend, I think that's more significant, right? Or if you're coming out of a range of price, right? Or you've just made a new high and all of a sudden you see a larger put ratio, that might be more significant, all right? Okay. Getting through some of these, Gene. I'm getting through a lot of them. Great questions today. So Bruno asks, why is it important to check for a spread, right? Because Bruno, if we see a large amount of volume based on our new open interest, and I've now discerned that that is part of a spread, that might not mean that this is unusual, right? That somebody's making a big bet and that they believe that that price is going to jump in a very short period of time or over a longer period of time. It just could be part of the business of a large institutional trader who has made a bet, markets rewarded them, now they're going to take in their profits and then they're going to put the bet back out again, right? It's just part of the doing business, right? So that's why I think, volume and open interest is a lot more important in that case, and also make sure that there's not those corresponding puts or calls or strikes that are near it. All right, Bruno? Okay. So Camellia, I think we asked, can we tell that they're buying or selling? I showed you that through the history, price history, and also our green and red light, right? So Christine Sims asks a great question. It says, should this research decision be done intraday or could it be done on the night prior? Yeah, Christine, yeah, for sure. Why not? Especially if we're looking at longer dated options, right? Right. We don't need to jump in right away, right? We might actually, wait for a little bit of price confirmation. Yeah. So yeah, you can definitely do it. Now the problem is that, you might set your plan out based on the closing prices or the price action you saw today, and then tomorrow, the market changes, right? The market could gap up, gap down, or that call that you were going to buy is now a lot more expensive, or the one that you were going to sell is a lot more cheaper, or whatever, or the news story came out, or whatever. So yeah, there's where you're at a little bit of a disadvantage, but surely you can definitely set up trades in the evening based on previous price action. Okay.
I'd like to pipe in here, John, if I could.
Yeah,
A lot
sure.
of people are asking if they can replay this. You are going to get an email later on this afternoon with the link to the recording, and you can always find this on our webinar archive page. So yes, you can go back and review this information later.
So Christine also asks, can you use unusual options for single puts or single calls? Yeah, I definitely will. If I feel that I can afford the individual put or the individual call, again, I want to make sure it fits my strategy, then yeah, I don't need to do a vertical spread, or I don't need to do a combination. I just showed you how to use verticals to help defer some of the costs, all right? All right, so I think a lot of these questions, John asked about historical data, I showed you that.
Again, if I can pipe in here, there are a lot of very, very specific questions coming in asking about specific, for John to look at a specific stock. Unfortunately, we can't give specific trading advice out here. This is really an educational session. But if John does not get to your question, and there are lots of them coming in, email our support group, support@barchart.com. We've got a great support staff and very knowledgeable with options, so they'll be able to answer your questions as well.
Yeah, I would reiterate that, there's some folks that are on the support staff that are 10 times more knowledgeable than I am, right? And so even if you go on the main page right down here, you can see where it says contact Barchart. That's another way you can get to it. So yeah, if I don't get to all of your questions, and I'm probably going to end in a few seconds here. Yeah, so send those questions to support, and they will definitely answer them for you. Okay, so let's kind of like sum up here a little bit. All right. All right. So what are some of our takeaways? Right. What is the volume as it compared to open interest, right? That's how our page is designed. But also we're going to look at volume and open interest in the big picture, right? The total open interest of our individual security and the total open interest of those particular strikes, all options, and those expirations, right? Our daily volumes as well. Is our options part of a spread? How can we find that out? Well, we want to make sure we do that investigative part of our process, looking at those neighboring strikes and see if we see similar volume being traded. That could be an indication of a spread. What are the details of the trade, right? Remember, think about the trade in the whole. Is the strike in the money, at the money, or out of the money, right? What is that institutional trader telling us, right? When is expiration, right? Is earnings going to be affected with it? And what are the ramifications, right? If somebody is buying puts, does not necessarily means that they think that price is going to down. They might be buying puts as an insurance. But if somebody's selling puts, what is their ramifications if they get exercised? That means they have to buy that option. So that might be bullish too, right? When is earnings, right? So this is not a standalone earnings, right? In terms of unusual options. If I find earnings and an options expiration on top of each other, then that is significant. But I also would argue that if I'm trading a short dated option and my earnings is, not for another month or so, that also could be very significant, right? That because the earnings is not going to be the catalyst that's going to drive price, right? Something else might be driving price. So that would be important as well. What is the dollar value of the trade, right? Options times the dollar cost, right? Times how many options, right? So one option is 100 shares, right? How many shares is that trader trying to control? And what is the dollar value? If you see somebody who's trying to control, 1 million or 2 million or 3 million shares, and the daily volume of that stock is only about, 5 million, they're controlling 50% of the daily volume, right? That's huge, right? but what's the dollar value, right? If somebody is trading and they put out $1 million bet on 100 or 200, or like in example in Google, where it costs you $30,000 or $40,000 just to buy 100 shares, maybe $1 million is not a big bet, right? So it's, again, that will be relevant to the value of the stock and the size of the shares being controlled. If somebody is buying, let's say, 100,000 shares and they're spending $3 or $4 million, that could be a lot more significant, right? And then, has our unusual options activity distorted our implied volatility in terms of our rank and our percentile? And that will help us set us down that path of, do I want to try to capture some form of credit? Do I want to help to offset the costs? Do I believe that the options are relatively cheap, where I could just be single-sided like Christine asked? Or if the options are expensive, where my implied volatilities are large and my ranks and percentages are on the high end, and now I'm going to use that offsetting strike to offset some of my costs. Okay. So I hope you guys enjoyed today's session. I want to also remind you that you can sign up for a free trial. A lot of the features some of the features that we've gone through, and a lot of the stuff that I've done in other presentations, there are some premium components of it. You can try our premium package for a 30-day process, and it's definitely something that I would encourage you to do. I know Gene is going to ask me to show this, and as I do all weeks, is our upcoming session, but where I usually get to talk about the upcoming session, we have a special guest next week, right, Gene?
That's right. Next week, I am going to be hosting a session with Jim Van Meerten, who writes our Chart of the Day newsletter. A Chart of the Day newsletter is a free newsletter that we have hundreds of thousands of people get this to their inbox every single day. It's a trading idea, and Jim is a very accomplished trader, and he is going to be sharing with our audience how he comes up with this daily chart of the day, why he thinks it's a good stock to look at. It's going to be a really interesting session. If you are interested in getting some good tips as far as what a pro does to look for good breakout stocks, I suggest that you join us next week. We'd like to see you
I'm
there.
definitely going to sign up and watch that one. I know that
John, you're going to be taking some time off, so take some time off and enjoy yourself.
I might. Okay, all right. I'll watch the recording. I won't be live, that's for sure. I'm going to be in Vermont next week doing some late spring skiing, so I'm looking forward to that. But I want to wish you and Jim success and good luck next week, and I am going to watch the recorded session, so I'm looking forward to that. So with that, I want to wish everybody the best of health, stay safe out there, and the good of all trading.
Thank you, everybody. Thank you for being a Barchart member, subscriber, visitor, and we hope that you come back again.